Hey everyone, welcome to Chapter 2, Financial Statements. In this lecture, we're going to take a look at two specific learning objectives, so 2.1 and 2.2. And we're really just going to focus on the interrelationship of the four financial statements: the income statement, the balance sheet, statement of retained earnings, and the statement of cash flows. And we'll discuss on the process by which these statements can be used to project a firm's future cash flows, in which are basically essential for accepting or rejecting projects that we'll be doing later on. So first, let's take a look at the balance sheet. In the balance sheet, we see a firm's current and fixed assets. We see also the liabilities and owner's equity accounts that were used to finance these assets. So therefore, the total assets figure has to equal or balance the total liabilities and owner's equity of a firm. It can be divided into 5 sections, starting with the cash and equivalents. So in this case, we actually see that this company, there's been a decline of $65 million. Now, an analysis of the statement of cash flows will help us determine why this decrease occurred. So more on that later. Next, we're going to take a look at working capital accounts. This shows the current assets and the current liabilities. Now, these directly support the operations, the firm, and the difference between the current assets and the current liabilities is considered our net working capital or absolute liquidity of a firm. Then we'll move on to our long-term capital assets. This shows the gross and net book value of the long-term assets at the firm's since the firm's inception. Okay, in this case, we see that this is the net value, so the accumulated depreciation has already been accounted for. But sometimes you will see a gross value followed by the accumulated depreciation. Just remember that we subtract the accumulated depreciation to get the net value. Next, we're going to take a look at our long-term debt, our debt accounts. So these accounts include all outstanding loans that the firm has taken for a period greater than 1 year. Now, as we continue to pay off the loan, the balance will decline. And finally, we have ownership accounts. So these include any capital contributed by the owners, which is considered our common stock. So in this case, there's been no additional contributions. And we also have our retained earnings. So the retained earnings of the firm since its inception. Now, the sum of both these components is known as our owner's equity or stockholders' equity on the balance sheet. Let's take a look at the income statement. Now, the income statement shows the expenses and income generated by a firm over the past year. Typically, you can see here, this is a year end, so it's shown over a year. Okay, so you can think of it as a video recording of expenses. Now, revenues are listed first, followed by the cost of goods sold, depreciation, and other operating expenses to calculate our EBIT, or earnings before interest and taxes. From EBIT, we can deduct our interest expense to get our taxable income, or earnings before tax And finally, once we apply our appropriate tax rate, we can deduct and arrive at our net income. Now, a few things to remember. The main point to remember, actually, is that net income is not the same as cash flow. So you can see in this case, this company earned a positive net income, but if you remember, there was a decrease of $65 million in cash. So why are they not the same? Well, there's three reasons that can help us understand this discrepancy. First is basically an accounting reason. So if you remember from our generally accepted accounting principles, firms typically recognize revenue at the time of sale, even if cash is not received in the same accounting period. Similarly, firms are billed for expenses that may correspond to a later period. So this is known as accrual accounting. Thus, the yearly net income figure could be different from the change in cash balance that has occurred during that year. Second reason is our non-cash expense. So some items on the income statement are non-cash expenses, such as depreciation. So depreciation, which decreases the carrying value of an asset, is actually an annual charge being shown based on the initial year expense. And finally, the third reason is simply a preference of classification. So since interest expense is part of financing decisions, and in finance there is a preference to separate operating decisions from finance investment-related decisions, we do not account for the interest expense on the operating cash flow because it's not an operations decision. Therefore, we can use these reasons to arrive at our equation for operating cash flow, which is net income, but we have to add back the depreciation and we have to add our interest expense as well. Now let's take a look at the statement of retained earnings. So the statement of retained earnings shows how the net income for the past period was allocated between dividends, and if any, so in this case there were dividends paid out, okay? So we simply need to add our net income to our beginning balance, subtract our dividends, and then we should understand how we arrived at our ending balance or more recent retained earnings. So once we have a better understanding of the company's position based off of the income statement and the balance sheet, we can take a look at our cash flow identity and the statement of cash flows. Oh, I was not recording. Shit. I'm recording here.
Oh, you are?
Yeah, look.
I want to see if you wanted to eat.
No.
It's alright, it sounded like you were talking to yourself.
That's nice.
No, I really record tomorrow. So is it slower?
I don't know what's happening. Now it's working, see?
There's a not on Zoom, but I will be soon.
Oh, I don't know if I'm doing the right thing.
No. Looks like you actually.
Oh, I am recording. Fuck.